Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
Herb, thank you so much for joining the podcast today. My first question, we've had an amazing bounce, obviously, after COVID lows and in 2020, with many people saying equities markets, they can't go any higher. What are your thoughts on the situation?
Well, look, obviously they can, and they are. So we hit an all-time high on the S&P. I'm going to just bring up my Bloomberg terminal here. We hit a new all-time high as recently as what looks like July 12th, 4,400 on the S&P. We're at 43.48 as we speak. Look, you have a lot of things happening. First, you have demand far outstripping supply everywhere. So I look back at past recessions. When you come out of a recession, you have very lean inventories and you have a big pickup in orders. So the backlog of orders, manufacturing orders, is at an all-time high and the inventories are at an all-time low. The only thing that means is great pricing power, tons of demand, profits equals higher equity prices. That's part A. Part B is monetary policy support around the world. Universal monetary policy support. The US is ultra aggressive, no longer willing to raise rates. As we approach the inflation target, we're going to let it run through. And then tomorrow, July 22nd, the ECB will meet, and I expect Christine Lagarde and company will get more aggressive from a monetary policy perspective. They're going to move to that transitory inflation target like we have here in the colonies, as you guys call us. There's really, what could go wrong? There's plenty, but that's why it's going higher and will probably continue to go higher.
Yeah, definitely. And then you said obviously there's increased demand and obviously not enough supply. Would you say that's mainly supply chain issues, or is it just an increase in demand, or is it a bit of both?
It's a bit of both. So this past recession, if you go back, I'm in my mid 50s. I've been doing this for over 30 years. Every recession we've had has been demand based, meaning the business cycle rolled over for whatever reason and demand evaporated. This recession was supply side based. We cut off the supply of everything. We had a global pandemic. We didn't know how bad it could or couldn't be. We didn't know could we keep people in factory and put a mask on? Would they be safe? That was all debated. And so we just shut everything down. Never happened before. Now we go to, shutting down's easy, right? Turn off the switch. But retooling, restarting, getting people back into work is very different. In addition to that, when we shut everything down, at least in the US, we did something we also have never done. We just wrote everybody a check and said, here's money. This new concept of modern monetary theory, if you give people money, they spend it. So now you have the means of production shut down forcibly, maybe for good reason, give everybody more money to buy stuff, and you have this massive uptick in demand that creates the bottlenecks in the supply chain, whether it's services or manufacturing. And that's where we find ourselves today. The risk on that is inflation, right? If we overshoot on inflation and the US Fed, obviously there are many central banks around the world, the Bank of England, the ECB, Bank of Japan. It's still the Fed drives everything, right? We know that. So if the Fed overshoots, which each day it looks a little more likely that they could, and then they have to suddenly ratchet up rates faster than expected, that's when you get your big equity market correction.
Yeah, definitely. So you'd say if they're having to chase and do massive increases in sort of interest rates, would you say that would be the time to maybe get out of equities a bit more? Or
reduce exposure. I think we're overweight equity to our benchmark. So for example, if we have a benchmark that's 70% equity, maybe we're 77 right now. And that's a very modest reduction from where we were a week ago, and a little bit more of a reduction from where we were, say, back in March, April. Why? Well, the market's gone up a lot. It's always prudent to reduce your exposure a little bit, even though we're quite bullish. That's asset allocation, that's risk management, risk containment. So yeah, I look, 5% corrections can happen at any time for no reason. 10% corrections usually happen for a reason, very difficult to predict, impossible to trade. 20% plus the bear markets, usually somebody in my shoes, a macro strategist, should see signs and begin to reduce exposure. We're not there yet. We have to see that, look, the Fed has to first reduce asset purchases from 120 billion a month, 80 billion in treasury, 40 billion in mortgage backs, then reduce it more, then raise the Fed funds and the discount rate. We just now started thinking about it. We're early times. And then don't forget, what is inflation? What is inflation? It's a redistribution of wealth, right? It's a tax that doesn't require legislative approval. And it redistributes wealth from savers to borrowers. So my kids are in their late 20s. They just bought their first homes. They have a mortgage. A little inflation for them. Their salaries and wages go up. Their mortgage is fixed. This is good for them. It benefits them. My parents in their 80s, who are on a fixed income, who don't have a mortgage any longer, right? They get harmed by it. And so if you're in debt, you benefit from inflation. What is the most indebted institution in the world?
The Fed, yeah, and the US government.
The United States Treasury, right? So the Fed's our central bank, Treasury is the one who's in debt. The Fed in our country is completely independent, there's no mandate that says make things good for the Treasury, but it kind of looks like they are. Right? They're buying up the debt so we can finance our budget deficits forever and inflating it away so we pay it back with cheaper dollars. It's I wish I had friends like that. So, US Treasury will benefit, the country benefits from inflation above that 2% target. I do think it will be difficult, a little more difficult than many of the voting members of the FOMC believe right now. We're seeing it in the earnings reports. So if you look through the earnings reports, we're in the midst of earnings season, the CEOs and the CFOs are saying, yeah, we've got some pricing pressure. We're able to push it through. But if we can't push it through any longer, that's going to be trouble for earnings and trouble for stocks. Labor here in the US, we've got extra unemployment benefits right now that go through September, so we can't get labor back to work. They're sitting at home. So, well, if I go back to work, I kind of make the same or just a little bit more. I'd be better off. It's summertime. Let's chill. So we need to get labor back to work here. And because the demand is so strong, we're having to raise wages. Wages are not transitory, right? You can't hire somebody and then in 6 months say, well, the price of copper has dropped and oil and lumber, so we're going to go ahead and lower your wage. It doesn't work that way. Some companies are trying to pay bonuses rather than higher wages, signing bonuses. I think that's a brilliant move on their part. I think that's a smart move. But the Fed needs to be very careful at this point.
Yeah, definitely. I think we saw in the sort of last report, as you said, wages and also rent, which, these things are a lot more sticky compared to a lot of the other transitory things. So you'd say that, there is the potential. And I found it interesting because a lot of the bond markets and everything else, it's not really showing people thinking that there's going to be sort of long-term inflation. It seems like they trust the Fed. Have you seen that as well?
Yeah, I think the central bank in the United States has more credibility than any other central bank in the world. Because of the way we appoint the voting members, the way we appoint the chair, the rotation of the voting members through it, the fact that it is independent and it doesn't answer to Congress or answer to the president. So it is a very trusted institution. I do believe that, obviously that every member, regardless of which president appointed them, does have the best interests of the country at heart. I think people generally believe that. But I also think there's plenty of room for a policy mistake, right? That's true of anybody. No matter how smart or well-intentioned you are, you can make mistakes. And the big risk today for our central bank, and for all of them really, for the Bank of England, is that we overshoot on the inflation and we have trouble bringing it back in. Would I say that that risk is more likely than not today? I wouldn't. I still wouldn't put that a high probability of that, because if you look at the last few prints on CPI and PPI and you look into the components, they're still very much in the reopening components, airline tickets, hotels. And then you look at the commodity contracts going out, most of them are in backwardation, meaning the out months are lower right now. And that suggests the Fed may be right. I mean, Jerome Powell, 5 years from now, is either going to be heralded as the greatest Fed chairman of all time, chairperson, or the guy who brought back the 1970s inflation, and he'll go out, tarred and feathered out of office.
Yeah, definitely. So would you say that those looking further into the CPI are the key indicators for you in the future? So you mentioned hotels. I also saw, secondhand car sales and car sales as well, a key factor of that. So what would sort of change your perspective on this, or change your mind that it may be a bit more long-term?
That the inflation would be a bit more long-term? S&P 500 profit margins. So that would be a really good early indicator. And that's why this earnings season is pretty important. Now, we haven't gotten into what I call the meat of it. That's next week, because tech companies, big tech, I'm going to guess they're going to blow out every possible number. I mean, the cyclicals are blowing out the numbers. So the financials blew out the numbers. Stickier wages, stickier rents. Like right now, I think commodities have a lot of downside. So we're good, but you just have to start seeing it more of the non-reopening stuff, more than just used cars. Yeah. We got shortages driving up prices temporarily, shipping, I don't know I didn't look at Baltic dry shipping this morning, but I'll bring it up real quick. Baltic dry index graph at 3,050. That's still pretty high. I mean, the all-time looks like it was about 34.18 on June 29th. So we're still pretty high. We need to see these things continue to roll over before we can worry about it. The other thing the Fed points out, and I think they're right to do it, we still have a lot of deflationary trends in the world economy. That's innovation and technology that's driving efficiency like we've never seen, right? I mean, I'm going to hold up my little iPhone 12 for you. There's more computing power in my hand right now than existed in the entire world in 1980, right? Yeah. So I can buy a 60-inch plasma TV, hang it on the wall, and throw it away every month and buy a new one for a few $100s, where 10 years ago, that same TV with less quality cost $10,000, right? So maybe the Fed's onto something. I hope they're right. We all hope they're right?
Yeah, I think it's the thing. It's just, sorry.
Oh, I did break out my Ford administration with inflation now button.
Okay.
If you probably don't remember these buttons, but I bought this on eBay. Everybody wore these during the 70s because we were trying together to whip inflation now win. So I got this on eBay, and I keep it on my briefcase, and people see me on the airplane. They go, "Oh yeah, I remember that."
Yeah. No, I haven't seen one of those. That's quite interesting. So, but yeah, it is. Do you sort of see any other macro trends that are could obviously impact the market, or any other data that you're watching?
Well, I think that the most overvalued markets in the world right now are the markets for US Treasuries, right? So you have every possible buyer, including the central bank, which is like paying off your Visa card with your MasterCard advanced checks, right? We're literally, the central bank is just sucking up the debt. So my view is that, and I've been wrong so far this year, is that with real yields on the 10-year Treasury at the most negative they've ever been. Let me just bring it up. Real 10-year yield based on core CPI US is minus 301. And I'm going to graph this out and do a max chart here. real yields on 10-year US Treasuries in the 80s were up over 8%. We've only gotten to this negative level twice before. June of 80, we were at minus 350. We're at minus 301 today. And then December of 74, we were at minus 370. Both of those cases, it was a sharp spike lower, exactly where we are today. And then bam, it just got away. So I think right now, your biggest risk is a bond bear market in the out maturities. Obviously, a 3-year maturity can't go down very much, right? But 10, 15, 20, 30-year USTs, I think you have just a high risk of eventually somebody goes, wait a second, why am I holding this stuff? Right? It's paying me 1.2%, 1.29% this morning on the 10-year, but inflation is going to run 3% next year, 4. Break even. What's the 10-year break even this morning? 10-year break even is at 230. Okay. Yeah, I think that's a big risk. There's always the geopolitical risks, right? The U.S. and China are not exactly buddies right now, and that's the same regardless of who's in power in the United States, what party. I think that's a universal agreement. I'm concerned about the warning that U.S. companies and British companies were given in Hong Kong by the American government. That's a major financial hub for the world over there. I think that gives me pause. I think we could talk the threat that crypto plays, that the threat that crypto represents to world peace. It's weird, but I think we're going to get there. There's always a lot of risks.
Yeah, definitely. Well, what you were talking about, sort of the bond market and potential bear market, I know Ray Dalio sort of talked quite a lot. I'm not sure if you've heard his perspective on it. And yeah, he sort of said he believes that it's the US coming to the end of a debt cycle. I'm not sure if you've heard that opinion or if you agree.
Well, I haven't heard him say it per se, but yeah, I mean, the US can borrow money at minus 3% right now.
Yeah.
Yay, America. We can borrow money at minus 3%. How long will that last? And let's just say the bond market says, no more, Uncle Sam. You got to borrow money at a real rate of 2%. Well, that means we can't run these budget deficits forever. That means we have to cut government spending. That means borrowing costs go up across the economy. That is a slowdown. That is a correction in the stock market of pretty sizable proportion. That's when you can see your 25, 30%. Now, am I positioned for that on the equity side? No, I'm not. I am still bullish because I think easy monetary policy goes till at least the end of 22. But on the bond side of the portfolio, I'm positioned short. I just don't see any reason to stick my neck out at 10, 20-year maturities on bonds. And the argument against me would be the 10-year treasury might go to 1%. And okay, it might. But, I can also go bet on Manchester United to win the World Cup, whatever, you know what I mean? Right.
Yeah.
That to me is a big bet.
Yeah. It's definitely more likely for to increase, obviously, for the the yield to increase rather than decrease, I'd say.
Yeah, agreed. So look, fixed income is still important in the portfolio, provides ballast. Everybody's got a risk budget that you have to manage to. So you have to have that fixed income, but I don't even expect a positive real return on my fixed income holdings, maybe with the exception of high yield or EM local, because you're getting risk.
Yeah.
I don't expect a positive real return on fixed income for 5 years. Think about that. Yet we're still going to invest in it because we have to, right? Insurance companies have to. Pension plans have to, because you have an investment policy that contains a risk budget.
Yeah, definitely. So would you say they're the major buyers of, obviously, other than the Fed, of the US Treasuries?
Well, you've got mutual funds, ETFs, you've got massive endowments and pensions around the world. And you got to remember too, just the other month, we had a near record budget deficit. Trade deficit.
Yeah.
So think about it, the U.S., world's largest economy, we run a trade deficit. And when we buy stuff from China, we don't buy with renminbi. We buy their stuff with our dollars. So these manufacturers in China are sitting there with buckets of US dollars, right? Buckets and buckets of US dollars. Well, where do they put it? How do they save it, right? They buy US Treasuries. So I always found it kind of unique. The last administration, we were really hell-bent on reducing the trade deficit. Okay, I get it. It adds to GDP. There are national sovereignty and security benefits to not relying on China for computer chips, which we're learning right now. I get all that. But if you don't run a trade deficit, who's going to finance your budget deficit? And so right now, the rest of the world's willing to do that. I mean, it all goes back to Bretton Woods, right? We took over financial sovereignty of the world from you guys. Sorry about that. When Morgenthau, Secretary of the Treasury, Morgenthau and Keynes, they all went over to Bretton Woods at the end of World War II and decided, how things were going to be. And, America, yay, we became the world's reserve currency. And so we have this privilege of being able to run these perpetual deficits. Everybody in the world would prefer it was their currency, right? The Russians, not going to happen, corrupt communist regime. China, not going to happen, corrupt communist regime. Euro, not going to happen just simply because the structural problems in the economy in Europe. So Japan, stagnation, deflation, not going to happen. The Swiss franc or the British pound, both safe, legal, protected currencies with tort systems, not big enough, right? So what replaces the US dollar, and it's not Bitcoin in my lifetime, maybe in your lifetime,
Yeah.
but and we can go for 3 hours on crypto, but right now it's the dollar, yay dollar. But we don't treat it well. We have this great privilege, and then we're very profligate with our dollar, right? We overspend, we underfund our two major trust funds, which is Medicare and Social Security here. And we are spending at a level consistent with a war or a recession right now, and we're not in either. So what happens when we do hit a war or a recession?
Yeah, it's quite unprecedented situation, isn't it? And I think you said it's similar to Bretton Woods, where it gets to the point where people just, they've had enough. And I think that's what happened, where people were trying to exchange their, US dollars for gold, and then it sort of collapsed. And hopefully it doesn't happen soon, but, I guess that's the potential risk, isn't it?
It is. I think when you're in a position of strength, where the U.S. has been since the end of World War II, I think you need to be careful to protect it. And I think we're getting close to the edge of being the irresponsible kid whose parents pass away and leaves them with millions, and they run out and they buy Ferraris and they buy cocaine and they go to Vegas. Okay, we're kind of there, right? We're getting close to that. And as opposed to the kid who gets the inheritance and invests it prudently and wisely and doesn't overspend and isn't flashy. America needs to, we got to be careful, because there's a whole lot of very, very smart and now very productive countries, i.e. China, that would like nothing more than to replace us as the world's dominant economic, monetary, financial force in the world.
Yeah, and we are seeing it as obviously quite a lot philosophical shift as well happening in the US, and sort of, you said it with the checks that were sent out to people, and obviously the unemployment as well, trying to look after everyone, which I guess, as you said, it is good, but don't want to push it too far.
Yeah, there's just a limit, and that's the debate here. I think if you take the two major sides in the US, on the fringe of one, you've got, I want, in our Congress, it'd be like the Bernie Sanders, Elizabeth Warren. I want total, government takes care of everything. And then on the other side, you got the Rand Pauls, where the government takes care of nothing. the reality is the debate in our country is what's that line, right? So how much do you prevent people from starving and helping them, or single mothers or mentally ill? How much do you do that to the point, if you go too far, you disincentivize actual productive work? And I think everybody agrees that there is a line. We just don't know what it is, right? So our Democrats and our Republicans, Democrats are the left here, Republicans are the right. We're like, okay, where's the line? And I think the evidence we have right now is pretty clear that we went too far with the supplemental payments and the supplemental unemployment, because I can't get an Uber. Why would you drive Uber if you cannot drive Uber and get paid? Why would you take a job, an entry-level job as a busboy or a line cook, where I started? I was a busboy and a line cook. If I could get paid more to not work, and over my shoulder is San Diego, the La Jolla beaches, I would have hung out all day there drinking beer when I was 18, but I didn't have that. I worked for $3.18 an hour minimum wage.
Yeah.
So we did go a little too far. We need to get the people. We still have about 6 million fewer people working today in our country than we had prior to the pandemic.
And I found that interesting as well, that it's not just the unemployment number, it's the fact as well that obviously there's a lot of people who've actually exited the workforce. So it looks a bit better than it was.
Yeah. So yeah, the unemployment rate showing at 5.8 or 5.9, whatever it is right now. If you took the denominator, meaning the labor force, and you equaled it to what it was, I don't want to say the end of the last administration. The last administration, we had kind of a weird dude, but man, was he effective, right? I mean, it was great. We had more people working than ever before. We had 3% unemployment. The policies that were coming out of there were pretty good for economics and economy. The number of people working then in the labor force compared to today is far less. So people are saying, I'm not in the labor force. And we need policy that gets them back in the labor force. And when you incentivize people not to work, that's pretty clear that we went a little too far with good intentions, right? It was the pandemic. Oh my gosh, the kids can't be in school, so we need to, all of it was well-intentioned. There's no, American politics is so divisive that if you ask one side about the other, they'll all tell you the same thing. Those guys are bad, right? They're evil. They're rotten. They're not evil. They're not rotten. We're just trying to figure it out together.
Yeah, I find it's always best just not to look at the news. It's always so decisive, and then you read the comments and you're like, oh no, on the Financial Times over here, I'm just like, no, I'm just gonna ignore that. And
good policy right there for sure.
Yeah, definitely. So one thing you mentioned there as well was the geopolitical risks of crypto, which I find quite interesting. I know you said you could go on for hours, but maybe if you can give us maybe a bit more of a quick overview. Yeah.
So look, the U.S. is the world's superpower, right? We know that with our great allies in Europe, particularly the United Kingdom. And because we control the world financial system, we have the ability to implement foreign policy against bad guys without bloodshed. That's pretty good. That's important, right? So when North Korea or Cuba or Iran, which I believe everybody almost universally agrees are bad guys, right? When they want to do stuff and we can prevent them from doing stuff or mitigate what they do through the use of financial sanctions, that's a good thing. That means our young guys don't have to fire shots. People don't have to get killed. We can put the tourniquet on them financially. That's the beauty of what came out of Bretton Woods, right? And that's what beauty of becoming the world's reserve currency. So crypto, let's just go with Bitcoin, represents a threat to the ability of the US and its allies to implement their foreign policy. If China wants to buy oil from Iran and can do so with Bitcoin, that's a problem. It makes our sanctions less effective in Cuba, in North Korea, etc. That being said, I am in no way in favor of banning crypto or anything else. I do believe that we have to figure out the regulatory framework so that I can go to Starbucks and buy coffee with my with my Ether or my Chainlink or my Bitcoin, or send my kid money at college. Here you go, son. Here's $500 in Bitcoin, so that I can do legal things that have no negative impact on anybody else. But kidnapping, gun running, sex trafficking, human trafficking, and bad international foreign actors, we got to figure that one out. So that also represents a risk to our sort of global macro view. And the wheels will move slow here, right? Especially in this country, we don't like to be told what to do. So there's no way the government, it all becomes, because you guys used to tell us what to do, mind you, is if the government says you're no longer allowed to use Bitcoin, come on, that would make January 6th look like nothing. Americans do not and will not tolerate being told what to do. Ergo, government needs to figure it out. How do you allow people to do whatever they want without endangering other people? And I think that's where we have to go with crypto.
Yeah, and I think it's obviously quite complex over there as well, because you have the state laws and the federal laws and sort of how that works. So yeah, I know New York's quite strict on crypto and development, whereas other states are a bit more lenient. So I guess that's another issue, isn't there?
Yeah, in fact, New York, is it New York or Massachusetts? I think it's New York that has issued trust licenses to custodians for crypto. So the Winklevoss guys and a couple others now. So you can actually, a Coinbase is an example where they have a trust company. That's a big step forward. And I think we've sort of, I think Treasury has put out a rule, anything over 10,000 has to be reported. I think that's helpful. Whether or not it's enforceable, not enforceable, it's hard to say. But I do think crypto has a tremendous future as a medium of exchange. And here, like in the UK or the US, we have pretty trusted currencies. We're not worried about it. But ask somebody in Russia or China or Venezuela, right, where they would much rather work with Bitcoin than their native currency. I had an intern, a Harvard kid, a couple of years ago who was from Russia, and he's the one that finally opened my eyes. He said, Herbie, of course you guys love your dollar. It's nothing wrong with it. But man, if you live in Russia or Venezuela, forget about it. This crypto is a game changer. So then you got to make sure, how do you get the reporting? How do the local authorities get their tax and everything else?
Yeah, and I think that's what we're seeing at the moment. I guess I personally believe the way to do it is obviously on the, as you said, the exchanges, and putting the regulations on them, and obviously, creating it, making it very hard to actually exchange it illegally.
Exactly. And it'll come. It'll come. We got a lot of smart people working on it. I know the Fed is due to release a white paper here any day, if they haven't already. And then ultimately they'll get, public input, make recommendations. Fed doesn't get to make the law, right? That'll go to Congress. So it's gonna take time. In the meanwhile, the Cubans are probably buying stuff that we don't want them buying. Be my guess.
Yeah, definitely. So, you said that before, that you obviously your fund is overweight US equities and underweight sort of international equities as well. So you mentioned 2022 there as sort of the peak that you see. So you see sort of US exceptionalism continuing until that point?
Well, I'll be careful with the exceptionalism. I'm a very proud patriot. I love my country like everybody does in the world, and I love people that do. But I think the outperformance of the U.S. equity markets is likely to continue with a caveat. We passed the Tax Cut and Jobs Act of 2017, which lowered the corporate tax rate to 21%. That made the U.S. very competitive. We are in a legislative session now where potentially that could change. I think the markets could absorb up to 25 without really getting negatively impacted. Beyond 25, I think it would be a negative impact. We're talking about raising the tax on capital gains. The federal tax right now is 20%. If that goes to where the administration is saying, which I think right now is just bluster, but if it goes 30, 34 to ordinary income tax rate, I think that's an absolute killer for the equity markets, for capital formation. We have a very reasonable regulatory environment compared to Europe, right? The whole reason you guys got out of that EU, you were smart never to put your currency in there, by the way. But getting out of that was a very wise move because it is an overly regulated situation. So you have structural problems in the EU. I think the UK is moving away from those, by the way. You have structural problems in Japan in terms of the demographics and the disinflationary pressures. So the US is the cleanest dirty shirt in the closet when it comes to the opportunity for capital. The other thing that we have going for us here is if you look at, let's just say you look at the Euro Stocks 50, right? The big, I'm going to bring it up here. The Euro Stock 50, and you look at the holdings and you say, well, what's the largest holding? It's like Nestle, right? Great company.
Yeah.
But Nestle can't grow at 40% or 30%. So the growth engine of the world is, if you look at the S&P 500, look at these companies, right? The Apple, Microsoft, the NVIDIAs, the Facebook. So unless and until the rest of the world, starts going through some fundamental economic reforms in the case of the European Union, which it just seems near impossible because of the political nature of that group. And there's cultural things too. Like, you guys don't work in the summer. We don't understand that here. We just don't get it, man. Work is good, right? And you need to have more innovative companies coming out of the rest of the world. China's got some, Japan's got some, Europe's got some, UK's got some, but really the leading companies of the world are all in the US. So we're just going to continue to overweight the US until such time as there's some other reason not to. Do we own international? Yes. Do we own Japan? Yes. Do we own emerging markets? Absolutely. That's a growth engine in and of itself. But, it's a very broad brush to paint, emerging markets, right? And why is China still an emerging market, right? It just is, because nobody's figured out how to shift it from one index to the other without completely disrupting everything.
Yeah.
That is not an emerging market, but and it has a growth rate of 1, but in terms of its sheer size, it's absolutely massive.
Yeah, definitely. Well, that's what I've sort of seen. I've been focusing on emerging markets as well, more the smaller ones, Asian, ASE, and the places that have a bit more of a growth potential. So you say that's sort of a key as well to your portfolio, but you're obviously more overweight US.
Yeah, we're more overweight US on the equity side. On the fixed income side, we're just 100% US. Part of that is because our, the 99 or whatever percent of our investors are in the US. All of their future liabilities are in the US, and we're investing their money for them to be able to spend it on their future liabilities of food and energy and healthcare and travel and leisure and all the things that we hope to have in our retirement. But I'm looking at the top holdings in the Euro Stocks 50 ETF. You got ASML. I guess you could say it's tech, but then you got LVMH is number 2. Great company, don't get me wrong, but that's not the growth engine of the world compared to, compared to the S&P 500, where your top holdings are Apple, Microsoft, NVIDIA, Amazon, Facebook, Google, right? Even Tesla is now up there. Not so sure I like that idea, but it is.
Yeah, he's definitely. I think we are seeing a shift now, but as you said, it's very more traditional financial, obviously producers, all that sort of thing, the multinational companies. Whereas now, the startups are coming through and they're getting the backing, but it's just for them to grow into the behemoths, as you said, of the US.
Yeah, I do think, on the US side, and this carries from the last administration to this administration, there is a growing amount of likelihood that the US government will take antitrust action against big tech. If you remember 20 years ago, they did that, I want to say 20 years ago, with Microsoft. And Microsoft flatlined for quite a while till they got through it. And then, of course, Microsoft became a great growth engine as it is again today. But I think that the government is, there's cases to be made against Amazon, Facebook, Google, et cetera.
Yeah.
And so it's kind of interesting because we're 7 months into this new administration, and really there has been no major legislation, right? They're letting the economy kill it, and they have brought some antitrust, but that takes so long to work through. Companies would be wise to do their own breakups and sort of get themselves out from those crosshairs. We'll see.
Yeah, we will see what happens. So, sort of when you're looking at a company yourself, what's your strategy? So, what's your strategy of analyzing the company, seeing if it's something that you would be willing to invest in?
Yeah, so I guess I'm a GARP guy, meaning GARP, growth at a reasonable price. I am really more of a macro strategist than I am an analyst, but I can say broadly, I like a moat, some kind of moat. I like a little bit of value. Deep value is horrible, right? Otherwise, I'd be just sitting here buying energy stocks for the last few years. Some sort of protectable franchise around it. I mean, Apple's such a great example, as is Microsoft and some of these others. JP Morgan on the financial side, United Health on the health side. But I tend to be big blue chip. I tend to go with a history of rising dividends, not the highest level of dividend, a capital stack that is not overly indebted. I think the use of debt at low prices is great. I like to split it up amongst the different sectors so that I have kind of the best names in each one. Other than that, I just let the natural beauty of capitalism take the portfolio higher once I own the best quality names.
Yeah, definitely. And as you said, if you see those macroeconomic events coming, then you obviously, change out of those sort of stocks, or, you de-risk and do that.
Yeah, I think a great example was earlier this year, we had a discussion in our investment committee about, hey, we do see value or some of the cyclicals outperforming for maybe 3, 4, 5 months. And we all agreed that it was very likely to happen. But then we asked ourselves if it was worth the trade, right? So you got to sell out, pay tax, you got to be right. Then you got to get back in. Then you got to move back to growth, because we really feel over time it's growth, and that the old concept, the Graham and Dodd concept of value, which is discounting the assets of the company, and I don't know if so much of the assets are in patents now, how do you value that, right? It's not like you could value a plant like 30 years ago. So we ended up electing to just ride out that little 4 or 5 month outperformance of cyclical and value, and it worked. I mean, there was like 1 month we were a couple of basis points behind the bench, so that wasn't even worth the trade. And we wrote it through. Our overweight is with the Qs, and I don't know. I don't see Apple or Microsoft screwing up anytime soon. It's just amazing.
I think that's the thing, and those are the major drivers, aren't they? The top four, almost 20% of the whole S&P. So you really bet on them.
Yeah. Nvidia, I mean, going through a stock split the other day, and Amazon, Facebook, Alphabet. Yeah. And are they US companies, or are they just headquartered and domiciled in the US? And there's that whole issue now too. We still divide the world up the way we did 30 years ago. Well, how much do you have in the US? And then that sort of implies that it's a company that does all its business in the US. And of course, there's no such thing, right? Mm-hmm. Right. I imagine you have Microsoft software on your PC right now.
Yeah.
As does anybody anywhere in the world.
Mm. So,
the other, I forgot one of the negatives I could mention is a potential negative is, the US is now colluding with other countries in the G7, and now expanding that to the rest of the world, saying, hey, we're not going to compete by offering low tax on capital to try to attract people, right? Ireland did that so successfully a few years back. The US, quite frankly, did it in the Tax Cut and Jobs Act of 2017, where they lowered the corporate rate to 21%. And colluding on price is illegal in our country, right? I can't collude with you if we're both in the tuna fish business, right? We can't both agree to price a can at the same price. But the US government is now trying to collude with the UK and other nations to say, we will not go below a certain rate. And by the way, all you little countries, if you go below that rate, we're going to come and nail you. I don't know. That to me is sort of anti-competitive, anti-capitalist. We'll see how far it goes. Right now, it looks like it's going. Looks like Janet Yellen is making it happen. Our Secretary of Treasury.
Yeah, she's pushing, but as you said, I think it's Ireland, Estonia, and Hungary are the three, especially in the EU. They're the three countries that are, because they have quite low tax rates, and for them, how will they compete? That's what I think. How will they compete if they don't have a low tax rate? It's my personal opinion.
Yeah, I mean, you've got to have a low tax rate. You've got to have the rule of law has to be protected. The capital has to be safe. Contracts have to be enforced without bias. Labor costs matter. Education, quality of labor matters. One of the things I think that was a big mistake in the European Union was the currency, right? You have the poor countries. What do they have to attract capital? Well, they can let their currency depreciate. And now that, let's say Portugal and Spain and their currency is fixed with that of the Germans, that's not a good thing, right? You need that free floating exchange rate to get the free flow of capital to help the poorer countries. So that's why I don't think the euro is going to take over as the international reserve currency anytime soon.
I agree with that as well. And I guess we'll see in the future with inflation. So the interest rate, it might be the right for Germany and the other countries, but it might be wrong for Greece and Spain. And I think that'll be a major issue that we'll see, when one of those economies starts overheating, but the others can't afford an increase in interest rate. I think that'll be a major key part.
Yep, I think you're right on that. There's just no question about it.
Yeah, awesome. So what would you say are sort of the greatest lessons that the market have taught you over your career?
Never confuse brains with a bull market. That's one. I mean, I can't tell you, 34 years of doing this and the number of times the guy said, well, I'm going to go buy these 4 stocks over here that my sister-in-law told me about. She's a plumber and she heard it from the shoe shine guy. And then the stocks go up and they actually think they're smart. So I never try to think I'm too smart. The market will always humble you. I think that's very, very important to remember. I tend to avoid the momentum at all costs. And the temptation, I had a good customer the other day, a couple of weeks ago. I got to put everything in AMC. That's going to the moon, and I just like, no, you can't. That's not going to happen. So stick to quality, stick to your plan, never confuse brains with a bull market. Those would be my main lessons.
You three take away. Awesome. So thank you so much for the podcast today. I just have one question. Sort of, what advice would you give to maybe a young investor like myself or other listeners who are joining the financial industry, just to make consistent returns and to learn? What advice?
I think the most important thing you can do is to invest. And I'm always amazed at the calls I get where people say, well, I've got this little company and it's got a 50 million market cap. It's going to do this, it's going to do that, it's going to do the other. And I say, great. Is it a better investment than Apple Computer? They go, well, what do you mean? I said, well, do you own Apple yet? Do you own Microsoft yet? Do you own NVIDIA yet? Do you own Berkshire Hathaway, JP Morgan, Nestle, these great companies? And don't even think about or care about the price, the valuation, anything on the great ones. You got to own some of them first. I always tell people, just start accumulating those great companies, let them go where they're going to go. And when you have so much money, you want to speculate on some little thing, go right ahead. Can't tell you the number of calls I've got about weed stocks or other stuff. And I suppose there's a get rich quick in there, but I don't know how to get rich quick. I just don't. I just know how to invest for the very, very long term.
Yeah, I guess you'd say 9 times out of 10 they don't come off. Sometimes they do, but most of the time they don't.
And I'm not smart. I'm not going to confuse brains. The bull market here. I'm not smart enough to pick the weed stock that's going to make it. And we still have a lot of shenanigans in the stock market, pump and dumps, promotions, manipulations, fraud. And we have a lot of publicly traded securities. I don't know about in the UK, but here we have this thing called the pink sheets, where You don't necessarily have to have your financials, and everything is not as strict, which is great for capital formation for little companies and for jobs. I'm all for it. I just don't want to own any of them personally. Caveat emptor, I'm going to stick with the ones that have the audited financials that are well known, covered by lots of analysts. So there's very little opportunity for these companies to do shenanigans. There's opportunity, aka Enron, remember that one from 20 years ago. But for the most part, I think you can very much trust the audited financials of publicly traded, companies in places like the US and the UK.
Yeah, perfect. Awesome. So yeah, Herb, thank you so much for joining the podcast. If people want to hear more about, what you do, or if they want to get in contact with you, what would be the best way?
Well, thanks for asking, Anthony. First of all, thank you for the opportunity to be with you. I enjoyed it. I love talking about this stuff. I have a podcast as well. It's called Slaying Bulls and Bears. Slaying Bulls and Bears. You could say, hey Siri, play Slaying Bulls and Bears, or play Herb Morgan's podcast. And it will. And I think my phone is about to play it. I have to turn it off. It heard me. You can do that. My website is efficient-portfolios.com.
Okay, perfect. I'll put all that stuff down in the description so everyone can see it. But yeah, Herb, thanks again.
All right, Anthony. Thanks for inviting me. Talk to you soon.
Cheers. Bye.